Welcome back to Investors Reality. In this video, we're going to be looking at the financial implications of Russia's invasion of Ukraine and its impact on the global economy. And in today's episode, I want to talk about oil and gas production coming out of Russia. See, Russia, they have announced that it will be cutting back on its oil production and its gas production in 2023 as a direct result of the sanctions and the price caps that have now been applied against Russian energy. So in today's episode, I'll go through the announcement that the Russian authorities have made. We'll then have a look at what's happening to Russian oil prices since the price caps were imposed on December the 5th. We'll have a look at the relationship between oil and gas and Russian GDP, and we'll have a look at what's been going on with regards to the Russian ruble over the course of the last few weeks. Because things, they really started to deteriorate in terms of its value. And then finally today, I want to give you my 2 cents on the dollar to what I think is likely just going to happen over the course of the next 3 to 6 months with regards to the Russian revenues from oil and gas and what the impact of that is going to be on the Russian and perhaps even the overall global economy. Before we start, I want to welcome you to Investors Reality. Governments, they will change, and monetary systems, they will implode, and finally the future of finance will be introduced. In fact, the future of finance is being built right in front of our eyes, and it's being built on the blockchain. It's only a matter of time until the CBDC, the central bank digital currency, will be rolled out across the globe. And if you want to understand how to profit from this financial revolution, I do advise you to follow this channel, watch my crypto videos, and join my live streams. Because there's one thing I can guarantee you, and that is there's no one who's better than me when it comes to analyzing and investing into the future of finance. My name is Nico Harachi, and I'm the host of Investors Reality. The Russian Deputy Prime Minister Alexander Novak, he has announced that Russia may cut oil output by up to 7% in early 2023. As it responds to price caps on its crude and refined products and halt sales to countries that do support them. He went on to say that the cuts could reach up to 700,000 barrels per day. And they believe that in the current situation, it's even possible to take the risk, or there's a risk of lower production. So rather than being guided by the selling policy regarding the price caps, today it's $60 and tomorrow it can be anything else. So they don't want to be dependent on some decisions which are made by unfriendly countries, which is unacceptable to the Russian government. Even Russian President Vladimir Putin, he followed this by saying that he would issue a decree very soon on Moscow's actions in response to the price caps. Novak also said that this decree would ban sales of oil and oil products to the country that have joined the price cap and the companies that demand its implementation. The recently imposed sanctions, they have had a big impact on Russian exports in December, which are expected to fall around 20%. This is according to traders' data. Also, Europe's export from the Baltic seaports will probably fall by around 5 million tons in December, from 6 million tons in November. However, there are some estimates that are as low as 4.7 million tons. In addition to the oil reductions, Alexander Novak, he also went on to state that natural gas production and exports will also fall overall in 2022. Gas production by the end of the year will be 12% less than in 2021, and exports will drop around a quarter. And this is primarily due to the shutdown of export infrastructure, he said in an interview with the Russian news agency TASS. Furthermore, he also went on to state that LNG production will increase by 8.7% in 2022 or overall for the year. Now let's have a look at the Russian oil prices. Let's have a look at the Russian oil prices. This chart here shows the price of Russian crude oil over the course of the last 12 months. And when we look at the chart, we can see a big spike in March following Russia's invasion of Ukraine. Now prices, they then stayed high at around $100 per barrel for around 4 months. But over the course of the last few months, we have seen a reduction in oil prices as a result of the global slowdown. So as the economy has slowed down, demand for oil has reduced, obviously. And as you might know from simple economics, when demand reduces, that generally bring prices down. Now the chart for Russian oil prices is slightly different. We did see an increase in prices in March following Russia's invasion of Ukraine. However, what we can see in this graph is that in the 3 months following the invasion, the price of Russian oil actually fell. And that was due to a combination of a couple of factors. Firstly, a number of countries came out and stipulated that they no longer wanted to buy Russian oil. And a variety of other countries stated their intention to stop buying Russian oil overall. But the practicalities meant that they had to keep buying in the short term until they could actually locate alternative suppliers. Now, in order to offset this reduction in demand, what Russia did was to offer large discounts in the market to friendly countries. So the countries that were prepared to keep buying, they could. So as you can see that initially in the few months after the invasion, the price of Russian oil actually fell significantly and hit a low of around $68 on the 25th of April. And at that time, the global price for global price for oil was sitting at around $100. Now, between April and June, the discounts being offered by Russia actually started to reduce. And by the middle of June, the price of a barrel of Russian oil was trading for around $100. However, over the course of the last few months, we have seen a gradual reduction in that price as a result of the slowdown in global demand. As we can see that back in April, the discount was sitting at more than $35 per barrel. However, by August, that discount had reduced to around $24. But since the outright ban on the purchase of all Russian oil from European countries was introduced on December the 5th, alongside the oil price cap of $60, the discount has now widened again and is currently sitting at around $30 per barrel. And if we now go back to the price chart, you can see that the most recent price for a barrel of Russian oil is sitting at around $57 per barrel, which compares to the market price of around $80. And I think that the price of $57 is really interesting because the oil price cap is actually sitting at $60. So if Russia was to comply with the terms of the oil price cap and sell oil to all the countries who would want to buying it using this price cap, they would be achieving $60 right now compared to the $57 that they're actually achieving on their own mechanism. So currently they're actually selling at a lower price than the cap. But they deliberately don't want to comply with that cap because they don't want all of the terms and conditions to be tied in going forward, because the West could decide to reduce the cap further in the future, and that would obviously therefore reduce the amount of revenue that Russia is going to receive. So how is this going to impact the Russian GDP? Now, in terms of the importance of oil and gas to the Russian economy, this chart here shows the direct link to gross domestic product in Russia dating back to the start of 2017. And if we look at the figures for 2018, because that year was unaffected by COVID and was a period when countries, they were happy to buy Russian oil. So from there you can see that oil and gas revenues, they equated to more than 20% of total GDP for Russia during that period. Now, through the course of the COVID pandemic, the percentages did drop significantly, but that was obviously a result of a global reduction in demand for oil. We all stopped doing what we used to do. People were not going out in their cars, right? Nobody were going to work, people were not traveling, and all the airlines around the world, they were grounded. So there was a massive fall in demand for oil, and therefore there was a fall in revenues. However, as we are looking at oil and gas revenues as a percentage of GDP here, then the percentage obviously fell during that period, goes without saying. But as we then went into 2021 and the world started to bounce back, you can see that the percentages picked up again. And at the start of 2022, the oil and gas industry contributed 21.7% of total GDP in Russia. Now, however, Following Russia's invasion of Ukraine and the sanctions that have been applied against Russia and the discounts that we just talked about from the previous graph, you can see that the percentage of oil and gas revenues to total GDP has started to fall. And in the last 2 quarters, it has fallen significantly. In second quarter 2022, it dropped from 21.7% to 20.2%. And in Q3 of 2022, it dropped to 17.6%. So you can see the scale of the problem for Russia, because as the oil and the gas industry contracts, obviously the revenue will also reduce. And this is having a direct impact on Russian GDP, and therefore the Russian economy is not doing as great as it used to. And especially also as the industry gets smaller, so will the Russian economy. Let's move on to the Russian ruble. And this chart here shows the exchange rate between the US dollar and the Russian ruble over the course of the last 12 months. So this time last year, $1 was trading for around 73 Russian rubles. And that figure remained relatively stable up until Russia's invasion of Ukraine, when we saw an initial crash in the value of the ruble, and it was trading at 1.4 over 130 rubles for $1. However, due to a combination of support from the Russian central bank, which I thought was very smart, and also a huge contraction in the volume of trading for Russian rubles, not many countries in the world were looking to buy Russian rubles at the time. And therefore, as the markets reduce, the Russian central bank has been able to stabilize the price. So the Russian ruble strengthened significantly, and at one point was trading for around 50 rubles to $1. And over the course of the last few months, the exchange rate has stabilized at around 60 rubles to $1. However, if we look at what's happened over the course of the last month, you can see that there's been a significant deterioration in the value of the ruble. On December the 4th, which was the day before the European ban on Russian oil purchases and the oil price cap were introduced, the ruble was trading at 59.5 against the dollar. However, today it is now trading above 68 rubles. So this represents a fall in value of over 15% over the course of the last few weeks. And this is a direct result of the sanctions that are being applied and the lack of demand for Russian oil. Because the reason that there is some demand for Russian rubles is that the countries around the world are doing deals with Russia in rubles rather than the US dollar or euros. So Russia is trying to raise the profile of the ruble in order to get it to be equivalent to the US dollar in global terms. So therefore it wants countries to do trades in rubles. But as demand for Russian oil and gas is falling and the production is falling, as we just talked about earlier in this video, that then also means that the value of the ruble is starting to deteriorate. And that's exactly what we've seen over the course of the last few weeks. Now, if demand for Russian oil and gas continues to fall over the course of the next 3 to 6 months, it is likely that we will see a continuation in this deterioration in the value of the ruble. Before we end, I want to give you my and Kitty's 2 cents on the dollar. You see, if Russia is going to cut back 700,000 barrels per day, all of those barrels, they will be, or were meant to be, for the export market, because it's not going to see a massive fall in demand internally, right? So if we just look at it from simplistic, 700,000 barrels times $60 a day, because that is the oil price cap, I mean, that's the price that the world is happy to pay or want Russia to sell. And that equates to a lost revenue of approximately $42 million per day for Russia. Now you could argue that that is a lot of cash, right? Surely is. But we need to see what Russia is going to do. And they have come out and they have stated that they will not deal with any country that complies with the oil price cap. But what they're ultimately going to do, or what is going to be fascinating to see, is what the real response is going to be from all of the countries around the world. Because Russia, they cannot afford for everybody to stop buying. We know that, right? because that would mean that they would have to stop the vast majority of their production. So this could be a problem. However, I believe, as we've seen in the past, Russia, they know a thing or two about playing chess. Geopolitics is basically who is the best chess player. And until now, Russia has not disappointed in pulling out a rabbit or a joker. And don't forget, there's still a member of the Shanghai Cooperation Organization. If you don't know about him, I urge you to watch our video about the SCO and about the BRICS. I think many interesting things are going to develop or come to our attention in 2023. Now, in case this video gave you any kind of value, please do me a favor, hit like, smash, subscribe, and all them goodies. Come join the live streams for the crypto, and I hope to see you soon. Have a lovely 2023.